Hi, I'm James Robinson, and this is my stock pick of the week. Generally speaking, my stock pick is just a stock that I happen to think is a great pick that week. I analyze all the fundamentals about the company, trying to look for companies that have either a durable competitive advantage, fantastic returns on investments, or another way meet Warren Buffett's precepts for what makes a great company. I analyze these companies in a vacuum without looking at the stock price. I simply look for fundamentally solid companies. Once I've done that, then and only then do I look at the stock price to see if I'm getting good price for the value of the stock that we're looking at. My stock pick of the week. Well, this time what I've decided to do is something different. I'm showing you every week great companies that I think are good companies and have solid fundamentals. But I want to make clear that I've looked at over 800 companies and I have about 50 companies that meet my criteria of great companies. But if all I do every week is show you these great companies, you won't have a sense of how hard they are to find. So today I'm looking at a company that is not one of my picks of the week. It's a company that I would avoid. And that company today is, of course, Tesla. Tesla is primarily known as a manufacturer of electric cars. It also produces solar energy systems and battery devices for homes. The company is planning on entering the semi-tractor manufacturing industry in probably 2020, and those semis will be electric semis. Tesla currently produces 3 automotive products and has just announced its 4th. It produces the Model X, Model S, which is an upscale luxury sedan priced in the roughly $100,000 range. It has a similarly priced Model X, which is an SUV, and a more moderately priced sedan, which is advertised at $35,000, but is more practically priced at $45,000 to $50,000, and that's called the Model 3. Tesla has losses for 2018, but did manage to turn the corner and become profitable in the second half of the year. In 2018, Tesla sold 140,000 Model 3s, making it the best-selling sedan in America. The solar unit operation operates in 27 states. They installed 326 megawatts of solar panel power in 2018. That's enough solar energy in a single year to power 245,000 homes, or a city the size of Birmingham, Alabama, or Topeka, Kansas. So even though I'm not going to talk much about the solar business, it is a pretty large business in and of itself. As of March 30, 2019, the company had a market cap of $48 billion, revenues of $21.46 billion. It had profits, unfortunately, of negative $976 million. It had a PE ratio of 0. It can't have a PE ratio if you don't have profits, obviously. It paid 0 yield, no dividends, and it had debt of $13.83 billion. So this slide is the first indication there's something pretty bad with Tesla. In fact, in looking at this, it's amongst the worst of the companies, the 800 companies that I've looked at. It has a total GPA of 1.52. Its operating grade is 1 out of a possible of 4. Its management is slightly higher, and its grade for financial is slightly higher. Again, I look at a company based on 29 criteria, 9 of which are operating, 10 of financial, 10 are management. Operating is how well they supply their products to the customer, how efficiently, how profitably. Financial is how well they manage risk and use debt. And management is how well they return money to us, the shareholders. So looking at this company, I would almost think it's a Ponzi scheme as opposed to a solid company. It's just so bad in every category: gross margins, earnings per share, net earnings, selling general administrative. It goes on and on and on. I'll talk about the few positives. Cash and marketable securities, those are starting to go up, as you'd expect, because they're starting to get profitable. The retained earnings for the company, they're not horrible. There haven't been any earnings, so there's not much to retain. Shareholder equity. The shareholder equity is going up every year, which is what you would expect, but it's not going up proportionate to the amount of money that's being invested. Remember, you're going to find out later, this company is continuing to share shares to shareholders, so you would expect more equity because people are investing more company in the business. But long story short, there's almost nothing about this company that makes it a buy if you get past the speculative hope, which is one day these cars are going to be great, they're going to be profitable, and when they're profitable, the company's going to be worth a bunch. That's speculation. That's buying it today because you think someone else will pay more later. I'd rather buy companies today because they're worth something today, and hopefully they also become worth more later. But more on that in future slides. So if you've watched any of these slides, or these presentations, you know that my research always starts with gross margins. I like high gross margins. I consider that opportunities to make mistakes. If your margins are very high and you screw something up, you can still be profitable. But if your margins are paper thin and you don't have much room to move or maneuver, then when something goes wrong, as it inevitably will, it throws you into losses and can cause real trouble for the company. So ignoring the first couple of years, which is, sort of irrelevant because the scale of the company was so different than it is today. This company is always in the range of my minimum gross margins for even considering, and is, on the verge of being in the top 10, bottom 10%. Let's call it bottom 15% of all companies that I've looked at. So nothing is attractive here about the gross margins. Here we can see earnings and earnings per share. Obviously nothing to brag about here. The good news is that the company was profitable in the second half of 2018, and they believe that trend is going to continue, and it very well may, because this Model 3 is a really fast-selling car. However, there seems to be evidence that the sales have slowed down. They're also now going to start trying to produce the Model Y, which is the small SUV. It'll be several years before that becomes profitable, but they're investing a bunch of money in it now. Ditto with the issues with the semi. So I don't know that I see profits in the foreseeable future with this company. And when you look at the share price, you'll see that it's just no way to justify these prices. So net earnings as a percentage of revenue. Obviously this graph is really skewed by what happened in 2008, and it's hard to really make much sense of it, but it's fair to say this company is in the bottom 15 or 20% in net earnings related to revenue. And again, there are no net earnings, but there's a whole bunch of companies that also lose money that this company is comparing itself against. But in terms of being investable, this is a number for net earnings as a percentage of revenue, which is simply unsupportable. When I'm looking at a company and trying to determine how well it's doing operationally, the first thing we look at is the gross margins, which is total revenues minus cost of goods sold. That number is used to calculate the gross revenues. Then there are two other areas of concern for me as an owner. The first one is what I call the operating taxes. That's selling and general administrative costs, plants and equipment costs, research and development costs, and inventory costs. And so I look at those four things cumulatively, and every company seems to be high in one but low in another, and they kind of average out hopefully to a good number. I'm looking for companies that are either very efficient in all four or very poor in all four. And obviously if they're poor in all four, that's a red flag for me. So if we look at Tesla, for example, with selling general administrative, they're on the very top end of the 800 companies that I've looked at. Obviously they were very, very high before 2013. That was when the company was in its startup phase, and I give it a bit of a pass for that period of time. In fact, I even wiped out in this chart what they did in 2008 and 2009 because it was thousands of times too high, and it really skewed the numbers. The same thing for plants and equipment. You can see that Tesla is very, very high, amongst the worst companies in their cost for plants and equipment. So these are some of the reasons why this company is in trouble, because they just don't do a good job of managing these operational costs. So the next thing is inventory as a percentage of revenues. The good news is that Tesla, for the first time in the last couple of years, has been starting to bring this down. They were obviously in the bottom 10% of companies, but now they're sliding back down into the bottom 25% of companies. So that's a nice improvement, but it's not enough to make the company interesting to me. It's actually still something that would disqualify me. In terms of R&D, they're very, very high relative to most companies. Remember, about 50% of companies do no R&D, have no R&D as part of the budget. Tesla has R&D, which puts it in the bottom half of companies, and actually has very significant R&D, which makes it even less attractive. So if you look at the four taxes, selling and general administrative, they're too high. Plants and equipment, they're too high. Inventory, they're too high. Getting better, but still too high. And R&D, they're too high. This is a pretty clean sweep of things that make me disinterested in a company. Well, the next thing that I look at is debt analysis. Ideally, I like to see companies where the debt is decreasing. If the debt is increasing, I like to see it increasing at a rate that's slower than sales are increasing, and most definitely slower than profits are increasing. I don't mind if there's growth, it's just that growth has to be leading to profits. With Tesla, we have no profits, but the debt continues to grow. Now, the good news is from 2017 to 18, the debt was flat relative to long-term debt. I don't mind the total current debt going up because I understand total current liabilities going up, because I understand that the company is legitimately growing very quickly, and there is going to be increases in their operating costs. But when you look at this is a company between total long-term debt and total current liabilities. This is a company that has $20 billion in debt and no profits. That's obviously pretty scary for me as an investor. Obviously, what goes hand in hand with debt is interest expense. As you would expect, you can see this number is going up dramatically. Also, we look at interest expense as a percentage of income. That slide is not very relevant because we have no income. And so even though the number shows it's going down, you actually would prefer, the number just isn't telling because we're using the wrong equations. But interest expense continues to go up, almost parabolic, and profits have not gone up. And so we see this, again, bad news is related to this company. One thing I like to look at with a company is net interest expense. Net interest expense is simple. It's the amount of interest that you're paying or expecting to pay and the amount of interest income that you have, and you compare the two with each other. You can see the blue line here is interest expense. Obviously, that's going straight up. You can see the red line is interest income, which is virtually nothing. And so the net interest expense is just negative $700 million a year. Obviously, that's not good. You've got no money working for you. You've got a ton of debt. With Apple, for example, this was the opposite. You had net interest income, which surpassed your interest expense and created a profit center for the firm. There's no such thing going on with Tesla. Cash, cash equivalents, and marketable securities. So this is something that's encouraging. You're seeing that the company is having some money set aside for operations. The number that they have set aside has gone up in a relatively parabolic sense. Since 2015, it's leveled off. It's gone up a little bit, but I also know the company is not taking on new debt in the last year, and so this is starting to be a good sign. If they had not taken on debt and this number had plummeted, it means that they were using their cash to pay off the debt. But they are starting, it looks like they're leveling off and no longer using cash to fund or debt to fund operations. So this is slightly favorable. It's not something that makes me buy the stock, but it's something that lets me know that maybe this company, there is a light at the end of the tunnel for this company. Current assets to liabilities. As you'd expect with a company in financial trouble, so let me start over. Current liabilities are money that they're expected to pay within the next 12 months. And current assets are money that they either have or are expecting to receive in the next 12 months. And ideally, you'd like these current assets to be greater than current liabilities and hopefully offer some buffer. This company, of course, as you expect with a company that's struggling financially or that's a startup that's growing too fast, you see that its current liabilities are greater than their current assets, and that margin is getting sort of bigger, not smaller. That's a bad sign, but it kind of matches everything else with this company. There's not much to talk about here in terms of dividends per share. Obviously, if the company's losing $1 billion a year, they're not going to be paying dividends. This company isn't. I can't imagine when this company is going to pay dividends in the future. One of the things that I like about dividends is it means the company understands that they do have an obligation to the shareholders to return money to us, and it also means the company's operations are able to fund that. We look at dividends as related to profits and cash flow and earnings and debt level, and we don't have to do any of that with this company because there are no dividends. But if I'm looking at a company, one of the things I want is a dividend return, hopefully an increasing dividend return, it's easy to rule Tesla out instantaneously. And one of the things to keep in mind is that if, for example, there are investors who like dividends and this company isn't paying dividends, then that's an entire portfolio of potential investors who will never buy this stock. You'd love to have this thing having dividends that are going up gradually, that are sensible and fair returns on fair yields, because it means that the people who are likely to buy the stock from you is a larger pool, and that means it makes your stock more valuable. This is a look at shares outstanding, and this is a pretty terrible chart, and I'll tell you why. Every time this thing goes up and to the right, that means that the company has sold shares. Typically, they're selling shares to fund operations. So if they sell, for example, 10 million shares at $200 a share, that's $2 billion of new cash that they got, and that's great. But it also means that you've got 10 million shares worth of new partners, and it's reduced your equity, your position, your ownership portion of the company. So solid companies that are on strong financial footing, will typically be paying down or buying back stock, and thus increasing your equity over time. Tesla has really never done that 1 year. And the result is that every year you own a smaller percentage of the company that you used to. And let's remember that when they sell that stock, they're using that money to fund operations. So rather than debt, which can be paid off, they are simply taking on new partners and making your shares less worthwhile. And so in addition to borrowing whatever is $20 billion, of which 12 is short-term debt, long-term debt, in addition to that, they sold several $1 billion worth of shares to the market, and they've taken a bunch of deposits, which they're effectively using to fund operations. So when you add all that up, you realize, wow, this company is really robbing Peter to pay Paul in every imaginable way. And of course, that that should be something that concerns you. Just to put in perspective, if you own 10% of Tesla stock the day the company went public, that would have been about 7.8 million shares. Today, that same number of shares, 7.8 million, would have been diluted through stock issues, and today your equity would have been reduced to 4.5% of the company. Now you compare that to Apple, where if you bought X amount of Apple, every year you'd own a slightly larger portion of the company and get, therefore, entitled to a slightly larger portion of the profits. This is actually reversing and going the other way on you. We look for companies that are able to produce equity for their owners. We think in time, the equity that they're producing for their owners is a fair reflection of the value of the company, at least the direction they go. You don't expect a company to sell at book value. But so Tesla did a great job for many years for several years of starting to increase this. The last 2 years it's been flat. I don't know that it's enough to make me want to buy the company. I understand they're selling more and more stuff, so they ought to be building up some equity. The other thing about the shareholders' equity is, one of these that creating the shareholders' equity is by having shareholders invest a whole bunch more equity into the company, but all that really does is reduce or dilute your equity, as we talked about in the last slide. Return on assets, one of the two things that we really look for in a company is return on assets. An asset is simply something that the company is tied up, and money that the company is tied up in means of production, whether that's factories or plants or patents or whatever it might be, inventory. The company's using money, and we want to know how well that money is being used to throw money off to the shareholders. Again, they're not making any profits, so they're going to be in the bottom percentage of companies in terms of return on assets. So this is something that scares me. I like to see companies, that are above that red line, not that are, below the purple line. And it's very important. If I don't see that, I have almost no interest in the company, barring some extraordinary set of circumstances. Return on shareholders' equity is the exact same story. Here you can see the bottom 10% is the purple line. This company bounces around the purple line. I'm not interested in companies that bounce around the purple line. I don't want companies that ever look like they're near the purple line. So and the purple line is the bottom 10% of the companies we look at. So shareholders' equity, yet another red mark against the company. So the first question I ask myself about any company is, does it have a consumer monopoly? And the second thing I ask is that monopoly does it represent a durable competitive advantage? So I believe it's fair to say that Tesla does have a consumer monopoly. They are the only, or the best, and by a very large margin, the best manufacturer of electric cars. And in fact, they're so good that I love the product. I would consider and am considering buying a Tesla for myself. This isn't a question about whether the product's any good. It's a question of whether the business is run well. The second half of that question, however, is, does it have a durable competitive advantage? What I mean is, yes, they have the best electric car. How long will they have the best electric car? Are they going to be Apple Computer, or are they going to be BlackBerry? I think that Tesla is more likely to be BlackBerry. I think that they have an advantage today. They have a better product today, but it won't be long before Mercedes and Jaguar and BMW and Ford and Toyota and Chrysler and everybody else is making electric cars, and they're going to be every bit as good, or they're going to be significantly cheaper because those companies are better at manufacturing than Tesla. So I believe it does have a consumer monopoly. I just don't believe it's a durable competitive advantage. And so I think we're buying a company today that's either going to be gobbled up, best case scenario, or going to be run out of business by its competition as soon as the herd's able to catch up and pass it. Consider it like the Tour de France. You're out in front, but the peloton is riding behind you, and they're all drafting off each other. It's really hard to stay in front of the whole crowd for any significant period of time once they put the chase on. So in terms of the solar business, which is also a very large business, for all intents and purposes, it's a commodity business, right? There is no difference between one solar panel and the next. It's simply, do I want solar on my roof, and who does the best job of installing it, and who does it at the cheapest price? I don't like commodity businesses because I never know what the cheapest price is going to be, and I have to assume, in order to buy the company, I have to believe my company can be the lowest cost provider. And with all of the different things that Elon Musk is doing, some of which he does well and some of which he doesn't, all of the debt the company has, I don't believe that they're going to ever be the lowest cost provider in terms of solar. In addition to that, I think that the solar company is what I would call a medium-term rollout business. What I mean by that is, today, for the sake of conversation, nobody has solar. Let's agree that 10 years from now, everybody will have solar. Let's say that's the case. Fine. You can make your money out of this business by getting whatever piece of the pie you can steal over the next 10 years. But 10 years from now, everybody's going to have solar, and then there's no more market. It's like hot water heaters, right? You can sell a lot of hot water heaters when we're building houses. When we're not building new houses, there's no hot water heaters to be sold. And so once you get the rollout complete, the business shows down to a trickle. So you need to make sure that you get your money out in the short term during the rollout. And I don't see how you do that with Tesla because it's being dragged down by cars, dragged down by the semi, and I'm not sure they're the lowest cost and efficient provider in the first place. Next, is Tesla in a solid financial position? It's in the opposite. It's in a horrible position. They dilute their shareholders every year. They issue no debt. And oftentimes, they're not issuing debt in the terms of debt. For example, last year, they took on no long-term debt. But they are taking on deposits, which effectively is just debt. They're just not paying interest. It's a brilliant way to do it, but it's still debt. They have to either A, pay you back that money, or B, they make less profits when they sell a car because they already spent the deposit. So I think that financially they're in bad shape. Does the company reward its owners? So this is a two-part question. As a speculator, Tesla's done very well, right? The share prices have gone up dramatically, and so you'd have done great. So in the short term, Tesla has done well in terms of rewarding its owners, but it hasn't done it in what I'll call a sustainable way. If this company could no longer deliver growth and they simply did what they did today, for example, the company would have no value because it doesn't make any money. The company has to figure out a way to get profitable. They have to figure out how to do that in a sustainable way. They have to beat off the competition for one of the most competitive industries in the world. And so I just don't see that the company does a good. By the way, they not only don't buy back shares, they issue new shares. They pay no dividends. So I don't think this company does a good job of rewarding its owners. And for that reason, I'm not very interested in it. Long story short, there's no price at which I would buy the stock. I think there's significant risk that the investment would go to zero, is substantial. And I think that the company has to do an awful lot right to be fairly valued at its current price. I mean, you almost have to go to making $3 or $4 billion a year for this company to be worth the $40 billion of its market cap. So I have no qualms in saying this is not a good company to invest in. That's a fantastic example of something where the market is really excited about it, but it's all smoke and mirrors. So we've now been suggesting that you should buy stocks, or which stocks to buy, since the 4th of February, about 56 days ago. In that time, we've told you to buy 5 stocks. Altria Group, T. Rowe Price, Argon, Martin Transportation, and Apple Computer. I've decided to sell our original investment in Altria Group. We bought it at $48.90 a share, and I'm today suggesting you should sell it. I'm selling it at 57.43 cents per share. During the period of time that we own it, the company went ex-dividend, so in a few weeks we'll be getting a check for another $162. So the investment value as of the day we sold it was $11,800. We paid $9,900 to buy it, so that's a profit of $893. It's 19.1% return on investment. If you annualize that, it's 124%, so we did real well with that. Now, what I'm going to do with that is I'm going to reinvest my profits. I do that because I get my initial investment back, and I can go and spend that on other things, invest that on other things. But the initial investment in Altria, which works out to about $1,895, that investment will throw off dividends forever. I'm just going to forget I own it. I've already made my profits. I've got my money out. I'm going to leave the money in there, and I'm going to own it forever. I expect it'll throw off about $100 in dividends a year. And so for the rest of my life, I get $100 a year for doing absolutely nothing. And I have my principal back to go invest in other companies. That's one of the ways that I try and create wealth and try and diversify by, putting my profits back in the companies that did well. Now, that doesn't mean I'll always do that. And it doesn't mean I'll hold, in truth, I'll hold Altria forever. I'll hold it until such time as I think that the company is no longer fairly valued. If it gets really out of whack, then I'll sell it. But my goal is to hold it forever. So that's my stock pick of the week. Again, this week it was what not to do. But I thought it was instructive to take a look at, so that you don't, every company that I've shown you, there's a whole bunch of charts going up and to the right that look great. And I wanted you to have a sense that that's not always the way it is. And even companies that are hot in the market don't necessarily have any financial backing to make them long-term sensible, even short-term sensible investments. Thank you very much for your time.